The Rebel Capitalist Show.
I always say you've got to be prepared or you're going to be a victim, especially in this world that's so tumultuous and uncertain. And see, what's hard for me about bonds is because I have this motto that I just buy things when they're cheap and sell them when they're expensive, period. You got to start there. And
that's how you make money in real estate, right?
Yeah, you make money on the buy side. So, and there's just absolutely nothing that's cheap right now about bonds. Now, that doesn't mean that they don't triple in price. Who knows? But they're just not cheap right now based on historical standards. So what if this plays out with this, slight deflation, then a bump up to inflation, then a continual kind of grind down with this deflationary kind of Japan type setup? I mean, what does the average person do?
Well, the average person should first not put their faith in the Fed propping asset prices up. People have done that before, and it's a huge mistake. And if you think they can, they can't. And when you're surprised that they can't, you have a lot to lose. Now, is the bond market high in value? Sure, it is. But if you think rates can go to zero and you can understand how you make money by researching what duration is and how when interest rates go down, what that means to your principal value, it doesn't mean you have to hold the bonds. I mean, I'm sure it's the same, when you were, in real estate, George. I mean, if you buy a house in or something, it goes way up in value right away. You don't say like, well, I think I'll wait 10 more years. Sometimes you sell some of those things because, hey, it puts cash back in your pocket. Yeah. And that's the same with the bond market. Is you can look at it to hedge your risk assets. And the other factor is, if I'm right, those bonds will appreciate in value. Risk assets will depreciate. You sell your bonds and then go and buy risk assets cheap. I mean, or at a cheaper valuation. And then you rinse, repeat. I mean, you don't have to buy and hold.
And a lot of my viewers are really interested in gold, precious metals, Bitcoin. So within the framework of your view, how does that fit in?
Short term, I think precious metals. Now, I'm not an expert on Bitcoin, although if it trades like a risk asset, then I would have the same short term view of it. Okay. And I think we'll learn a lot about Bitcoin during the next recession that we don't have answers to. But in the short term, if real yields go up, as I believe they will, then because precious metals and gold are inversely correlated, they will bring them down. Okay. But following that, you should have a nice, perhaps multi-year decline in real yield. And there's your final blow off stage in precious metals and potentially Bitcoin as well.
Okay. So so you're saying that that you're predicting that we continue to have negative rates, so that they drop it negative and they take it far enough negative to where real rates are negative? And
well, I think as rates will go down and then they'll pop back up because everyone will perceive 0% will be inflationary. And to some degree it will. People will go out and borrow money, and then the smart money that's been sitting on bonds since 2016 will take advantage and unload their bonds like they've done in past market declines to buy risk assets. Okay. But once that new money stops flowing, because as interest rates go up, lending demand slows down, then it turns deflationary again. And that point, you see real yields decline. And that's where you saw that kind of post-great financial crisis, massive rally in gold for those who missed out on the pre-great financial crisis.
Got it.